Hi, good morning, everyone. This is Bridget Polachine at the IIB, and I'd like to welcome you to our Main Street Lending Program. Today, we're going to dive deep into the Main Street Lending programs that the Fed rolled out, I guess, a couple weeks ago. It's important to our members. I'm happy to say that we spent the first, 2 weeks of the programs making sure that U.S. branches and agencies were eligible to participate. And having that victory in hand, we thought it now made sense to turn to really looking at what these programs require in terms of being eligible lenders, both sort of the specifics of the programs, but also just, like I said, a deeper dive into how to access them and what you should be thinking about as lenders should you participate. So to help us walk through that, we're lucky to have experts from some of our associate professional members, Steptoe and Johnson, and we also have with us Deloitte. So presenting today will be Irina Jekas McCarthy, Monica Lalani, and Raj Shah from Deloitte, as well as Matt Culkin, Josh Oppenheimer, and John Collins from Steptoe. We really appreciate them making their expertise available to us. And I will also mention, I think the way we're going to do this is you should submit questions via the Q&A function on the webinar, and then we'll sort of curate those questions and ask them live as we go through the program, save them up for the end, but please submit your questions throughout. So with that, I think I'm going to turn it over to Steptoe and Johnson. Matt, you're going to kick us off.
Yeah, good morning, everybody. And Bridget, thank you for having us. So I'm Matt Culkin. I co-chair our financial services practice. I'm based in Washington. I know a lot of you from my previous role at the CFTC as director of the Division of Swap Dealer and Intermediary Oversight. But I think relevant for today, I worked in private practice on the post-financial crisis troubled asset relief program and some of those facilities. So working with my colleagues, John Collins and Josh Oppenheimer, to walk through some of the basics about the Main Street Lending Program. And as you know, TALF and others, right, they resemble, some of them are the same as the programs we saw in 2009 and 2010. So what we wanted to do was just give sort of the basics on the Main Street Lending Program. Folks have been waiting very patiently for these materials. It took about 3 weeks for the Fed to announce the final, for now, contours of the program, which changed based on feedback. They received about 2,000 comments in response to the initial term sheet. So what we're gonna do is I'm just gonna walk through the program very briefly, and then Josh will talk about the borrower's perspective on the program and what criteria they need to follow. And then John will talk about it from the lender's perspective in terms of eligibility, criteria, obligations, and potential liability. So what are we talking about today, right? So the Main Street program specifically, it's a program for small and mid-sized businesses, and it's for those that were in good financial standing before the crisis. I'll point out to you the bottom of the slide where we have in quotes, this is from the Fed, a start date for the program will be announced soon. Now, we've already seen some of the basics. There's certainly more detail to follow. And as you probably know better than I do, from the PPP rollout, right, there are a lot of unanswered questions. So when we talk about Main Street, we're really talking about 3 different programs all under the same umbrella. We're talking about a new loan facility. We're talking about a second, they're calling it the priority loan facility, which also is a new loan, but with slightly different criteria. And then we're talking about expanded loans or amendments to existing loans pursuant to the program, so that existing customers can get additional relief. The basics of the program: borrowers have to have less than 15,000 employees or less than $5 billion in annual revenue. It's an either or, it's not both. Those are both criteria that are more generous than the original proposal. So it's going to capture or be available to more companies. And specifically, the Treasury and the Fed have made clear that PPP loan participants can participate here, right? And so we're seeing a little bit of the dynamic that PPP is oversubscribed, and so Main Street might be an alternative source of relief. In terms of the things that we're still waiting for, certainly the lenders are waiting for a go live date, model documents, specific criteria that go beyond the frequently asked questions. And for borrowers, because it's a private loan program, they're going to need to work with their banks to get the details on how the bank is going to carry out the program. So those are sort of important components that we're still waiting to see. In terms of the basics of the loans themselves, 4-year loans, minimum loan size for new loans is $500,000, which is lower than the original proposal. So again, making it more widely available. 1-year forgiveness in terms of repayment, different risk retention levels for the banks you can see on the screen. So the priority loans have a greater skin in the game component. LIBOR-based loans, they were originally proposed to be SOFR-based, so the Fed has switched to LIBOR. And you can see the maximum loan sizes are generally tied to EBITDA, with a cap of $25 million for a new loan, $200 million for an expanded loan. The next slide has a lot of the same things. These are sort of the basics these are the things that are most important to a borrower. But the idea is to provide the loan now and then let the borrower use the next year to put the funds to work and then begin repayment after that. Similarly, on the next slide, we've laid out the maximum loan size just to give you sort of the ceiling, the floor and the ceiling. For new loans, $25 million. On the new loan program, it's the lesser of $25 million or 4 times EBITDA. For the priority loan program, $25 million or 6 times EBITDA. And expanded loans, it's a little bit more complicated, $200 million, 35% of outstanding but undrawn debt, or 6 times EBITDA. So those are the basic commercial contours of the program. And now I'll let Josh talk about what the borrower's criteria looks like.
Thanks, Matt. So the borrower, what is a business? The business is legally formed. It's a for-profit entity organized as either a partnership, an LLC, a corporation, an association, a trust, a cooperative, a joint venture with no more than 49% participation by foreign business entities, or a tribal business concern. Notably, it is not a nonprofit organization, and the Fed and Treasury are still debating and evaluating whether to include those nonprofits in this program as well. As Matt mentioned at the top, a business can have up to 15,000 employees or up to $5 billion in 2019 annual revenues. It must be a U.S. business, which means it's created or organized in the U.S. with significant operations in and a majority of its employees based in the U.S. And notably, the SBA, Small Business Administration rules on loans to affiliated entities apply to Main Street borrowers. The business must be established prior to March 13th, 2020, and it can't be an ineligible business. An ineligible business is one of the businesses, if you weren't ineligible under the SBA Paycheck Protection Program, you would also not be eligible under the Main Street lending program. You are, however, permitted to take out both a PPP loan and a Main Street loan, but you cannot take out more than one type of Main Street facility, whether it's the new, the priority, or the expanded loan. And you cannot participate in both the Main Street Lending Program and the Primary Market Corporate Credit Facility, which was established to support larger companies. You also can't have received specific support under Title IV of the CARES Act, and this relates to air cargoes and air carriers, repair operators and ticket agents, and businesses critical to national security. Next slide, please. So in terms of the borrower certifications and covenants, these are what the borrower is going to have to assert. And let's keep in mind that the lender will not be responsible for digging in and confirming these certifications and covenants. So the borrower will need to make a covenant that it will make commercially reasonable efforts to retain employees during the term of the loan. It must commit to refrain from repaying the principal balance of or any interest on any debt until the loan is repaid in full, unless the debt or interest payment is mandatory and due. And for the priority loans, the borrower may refinance existing debt owed to a different lender. The borrower must also commit that it will not seek to cancel or reduce any of its committed lines of credit with the lender or any other lender, and also must certify that it has a reasonable basis to believe that it has the ability to repay the loan within 90 days. Additional certifications are what we've seen in other Federal Reserve and Treasury programs. There are compensation, stock repurchase, and capital distribution restrictions, as outlined here, as well as the borrower must certify it's not in any way connected with the president, the vice president, the head of an executive department, or a member of Congress. Again, as I said, the lender does not need to independently verify the borrower's certifications and covenants. John, I'll pass it off to you to talk about the lender eligibility.
Thank you. So I will highlight some of the lender parts of the Main Street program. And for eligible lenders, this means those that are U.S. federally insured depository institutions, the banks, savings association, and credit unions, as well as holding companies and savings and loan holding, bank holding companies and savings and loan holding companies. And what the Fed did was added the U.S. branches or agencies of foreign banks and U.S. intermediate holding companies of the foreign banking organizations. So those are the basic group. Also, any U.S. subsidiary of any of the foregoing would be an eligible lender. At this point, other non-bank or non-bank financial institutions are not eligible. But as you may have seen in many of the Fed documents on the program, the Fed has indicated that it will look at this type of issue on an ongoing basis. So we may see them permitting some institutions that are not affiliated with banks or bank holding companies. Under the next slide, we have the Main Street loan program underwriting standards. And this is for the lenders to pay attention to, because the loan underwriting and approval is the responsibility of the lender, not the Federal Reserve. And that's a major distinction from the other PPP program, where there was very little underwriting required. In this one, the Fed has made clear that lenders must underwrite each loan. And as part of that, the lender is expected to conduct an assessment of each potential borrower's financial condition at the time of the application and apply its own underwriting standards. And the Fed has also indicated that you can't just rely on the borrower certifications and covenants and eligibility criteria, that you must make an informed judgment based on any additional information that you may require or documentation in the underwriting process. So the Fed has also indicated that there's no guarantee that a borrower, even though they may appear eligible from the basic criteria for eligible borrowers, that they would receive a loan. Now, moving to the next one, we have the capital treatment of the program. And per the Federal Reserve, the capital treatment of the Main Street loan follows the risk assumed. And the Fed has indicated that the interest in the portion of a Main Street loan that is retained by a lender should be assigned the risk weight applicable to the counterparty for the loan, generally 100% risk weight for corporate or commercial exposures. For purposes of risk-based capital and leverage rules, the exposure follows that percentage of risk that the lender takes back. For the priority loans, it's 15% of the outstanding loan balance, and the exposure for the new loans and the expanded upsized tranche loans is 5%. And with respect to the expanded loan, the treatment applies only to the outstanding upsized balance, not the underlying loan itself. Also, the Fed has indicated that the secured Main Street loans would be eligible for credit risk mitigation treatment, provided that any collateral securing the loan is eligible financial collateral. And at the same time, eligible lenders are being told by the Fed that they're not permitted, which isn't a surprise, to recognize collateral attributes attributable to the Main Street SPV piece of the loan itself. There are various transaction and origination fees and servicing fees under the program on the next slide. The transaction fee under the Main Street program is 1% or 100 basis points for new loans and priority loans paid by the lender to the SPV, and the lenders may require the borrowers to pay the 100 basis point fee. For the expanded loans, the transaction fee is 75 basis points, and the lender will pay the SPV the 75 basis points and may require borrowers to pay the fee as well. The origination fees are 100 basis points for the new loans and priority loans. For the expanded loan, it's 75 basis points. And for all three programs, lenders will receive a 25 basis point servicing fee from the SPV. Also, the Fed wants to protect its interest, obviously, so there are loan subordination standards as part of the program. Generally, for new loans, the new loan may not be contractually subordinated to other debt of the borrower. And for the priority loans, it's similar. It must be similar. I'm sorry, it must be senior to or pari passu, meaning equal rights, basically, with the borrower's debt. That is, other loans owed by the borrower. And the expanded loans, similar to the priority loan standard. Few other items. Risk retention, Matt covered that initially. For new loans, it's 5% for the lender. Priority loans, 15%, and the expanded loan program, 5%. For the eligible loans, the new loans must be secured or unsecured and made after April 24, similar for the priority loans. And for the expanded loan, it's a secured or unsecured loan or a revolving credit facility made after April 24. The underlying loan must have at least 18 months remaining for maturity for this program. The other piece of this is that each of these loans, when you look at them as a lender, the Fed also requires that existing loans, either from the lender to the borrower, as of December 31st, 2019, must have an internal rating equivalent to a pass rating under the FFIEC rating system. So when you look at the borrower and you see their existing loans, they can't be special mention or any lesser category. They must have a pass rating. And finally, the lender certification and covenants, they largely mirror the borrower certifications and covenants that Josh had mentioned earlier. You'll see the elements of that the lender must commit that it will not request the borrower to repay debt extended by the lender to the borrower or pay interest on such debt until the Main Street loan is repaid in full. Of course, unless the debt or interest payment is mandatory, or in the case of default and acceleration. The other two items I should just mention, the note is the lender must certify the methodology for calculating the borrower's adjusted 2019 EBITDA for the leverage requirement is the methodology it has previously used for the same purpose when extending credit to the borrower or similarly situated borrowers. So you cannot shift or change the methodology for the calculation. And finally, and most importantly perhaps, the lender must certify that it is eligible to participate in the Main Street lending program.
Hi, Josh, excuse me, this is Bridget. We have a question that fits in with your slides on borrower eligibility. Jim might have to unmute you so you can answer it, but the question is, I think the question is generally about the affiliation rules for borrowers when determining the number of employees or the revenues. Would the employees of foreign affiliates and subsidiaries, under common control with the US borrower, do those get included when you're trying to determine whether the borrower hits exceeds the employee or revenue eligibility requirements? Oh, we can't hear him, Jim.
Let me try again now.
Yeah, we can.
Am I unmuted
Great.
now? Fantastic.
We can hear you now.
It appears that's going to be the case, that the affiliation rules, just like the SBA rules, will apply. Late last night, the SBA and Treasury actually updated their frequently asked questions with respect to the SBA program and explicitly said in FAQ, I believe it's number 44, that when you're counting the number of employees, you are to include the foreign employees as well.
Okay, great, thanks. So I think now we thank you, Steptoe presenters, and there will be, again, I'm gonna, encourage people submit questions throughout, and we'll either ask them live or save them up for the end. I think we're now ready to turn to Monica. I believe you're gonna kick off. If not, I'll just say Deloitte. Over to you for some of the operational considerations for participating in the program as a lender.
Hi. Can you?
We can hear you, Raj.
Thank you. Just one second. You can hear me, right?
We can.
Can you hear me?
Yes.
Yes.
I can't hear you. Monica, do you want to, if you can hear me, can you start?
Sure. So what we wanted to do in this section was, thank you to Steptoe to providing kind of the overview on the various terms and the eligibility criteria. In the next maybe 15, 20 minutes, we wanted to focus a little bit on some of the operational considerations that we're certainly hearing from speaking to some of our clients, and would certainly be interested in hearing from some of you through the Q&A on questions that you may be having. Maybe if we could just proceed to the next slide. So as we've kind of, evaluated the term sheet, like I said, spoken to others in the industry, I think there's some categories of potential considerations and even challenges that we've heard. that we wanted to maybe talk a little bit about during this section. I think the first one is just, as some of the FAQ is certainly starting to become more, we're getting more information, and some of the terms certainly changed as of Thursday on the new facility that was introduced, the priority one specifically. There are, I think, more strategic questions that we've heard many lenders start to raise around the particulars of the facility. Certainly things like, in terms of my customer base, do I focus on my existing customers first, or could this potentially represent an opportunity for us to expand into new segments or new channels, and focus on a different customer base? So questions that are focused around that, as well as, what kind of selection of the clients will this type of facility really lead to? So which of my clients will meet the specific EBITDA standards that this outlines, and will there be possibility of adverse selection in the type of borrowers that may avail themselves of this facility? Those are some of the questions I think coming from lenders, including, what are the economics around this facility, and is it viable for us to participate? From the borrower side, I think there's a heavy reliance on the attestation, as we heard Steptoe kind of provide. So, what types of checks and balances will the lender need to do additionally to relying on the attestation that will, give them the right level of control? Because I think in our view, we anticipate the reporting elements to be heavy in this facility, given that there's so much transparency that the Fed will be providing on the lenders, the borrowers, and certainly the reliance is heavily being placed here on the lender's current underwriting practices and controls. So I want to pause maybe on strategic considerations. We'll talk about reputational and some of supervisory, but Raj, if you're able to speak, if you wanted to add anything on this.
Sure. If you can hear me, I'll just say that I think it's a very interesting question that did not exist in the PPP facility, because this is a loan that was a grant. And we have been, in our discussions with some of our clients, we've been discussing this concept around, should you be looking for, of course, how deep how quickly and how rapidly can you help your own customers? That's a given. And what do you do from a strategic perspective? Do you look for those fallen angels? Because it becomes a very interesting opportunity for you. And so do you deepen that market segmentation and penetration? On the other hand, of course, you have to also worry about adverse selection problems here, because you might get inundated with requests. And I say inundated very advisedly, because we don't expect this to be a high volume transaction kind of facility. We expect this to be low to medium volume, high value transactions. But you might get a lot of companies coming to you, a lot of your existing clients who might be more distressed. So the question becomes a balancing act between helping as many as you can, because it's the right thing to do in the context of underwriting standards, but also, making sure that you are being prudent. So that's kind of the strategic choice we see lenders kind of debating. From a borrower point of view, as the strategic consideration is that, do I really want to go for this, given all the constraints that I have to suffer? And if I am really a fallen angel, would I not get a better deal anyway? So that's your pull and push, if you like, from a borrower-lender perspective. Again, I'll pause if there are any questions.
Yeah, I don't see any on the chat right now. So maybe we continue.
Yes, Monica, do you want to? Mm-hmm.
Sure. So on reputational risk, and I think, as we saw some of the things that happened with PPP, I think everyone's aware of some of the, the reputational aspects that many of the large lenders certainly faced in this regard. And so I think very similarly here, some of the same questions are arising around Main Street. Certainly there's both sides of participation and lack of participation, and really both sides of the coin here that can be viewed. But I think there's also an element of, how do you think about making sure you have the right controls around your processes, that your standards, et cetera, are up to, any potential reviews or sniff tests that the Fed may need to engage in, and that you have the right level of reporting in place, given that, as we talked about, there will be a transparency expectation on this facility, just like we're seeing on the others. So I think here, again, what we've heard is lenders are kind of looking at both sides and making sure that they can protect themselves with the right level of controls and reporting considerations in this area. So that's really from the reputational aspects. And I think on supervisory expectations, which really ties to really the point that I was just mentioning, we know that from a servicing perspective, the lenders will be expected to service these borrowers. They will be expected to perform according to their own underwriting standards and processes, and perhaps do additional checks above and beyond the borrower attestations that we provided. So while the supervisory expectations on reporting, I think, are still being determined, and based on our understanding of some of the Q&A that the Fed has done directly with lenders, they're trying to make it as easy as possible to really encourage the use of the facility. I think we expect that there could be some potential increased reporting expectations that would be required, especially if these loans end up in any sort of default or workout situation. So I will ask maybe our colleague Irina Gekas-McCarthy if she wants to add any points or underscore anything that Raj and I have said.
Hi, everyone. I think the only thing that I would probably highlight here is just recognizing and reminding everyone that this is one of the Federal Reserve's 13(3) section of the Federal Reserve Act facilities. And so as a result of that, you've seen kind of the broader context of even Chairman Powell on April 23rd reiterating the fact that the Federal Reserve is committed to transparency and accountability. And so that reputational risk and kind of the apprehension on both the borrower and the lender side, Monica mentioned a few points, but these are the types of things that could become public. The names of the participants of the facilities, the amount borrowed, the interest rate or discount paid, information around the types of collateral pledged, as well as the overall costs and revenues and other fees. And so just looking at the entire oversight from Congress, as well as Treasury, as well as the Fed, the transparency and reporting rules kind of transcend at multiple levels. And I think our travels in the industry would be everyone is watching very carefully in terms of kind of how the transparency and the reporting impact is playing out on PPP, just as a signal of what could be to come on Main Street. So there's certainly encouragement by the Fed to make it as simple as possible and leverage your existing processes as lenders, but recognizing there's apprehension even on the corporate side in terms of being a borrower of these types of facilities.
Okay, maybe we can move to the next slide. I know that this may be hard for some of you to see, but I think the idea here was that we actually kind of looked at the typical value chain of a loan processing, from application up until really the end, portfolio management and reporting, and just started to think through where we expect some of the impacts to be because of Main Street. And you can see what's happening here, at least in our initial views right now, is it's much more of a barbell effect where we expect, some of the impact to really be on the front end in terms of eligibility, in terms of some of the attestation, borrower attestation requirements, the documentation that will need to be collected, and how the new terms will need to be certainly absorbed into the front end of the cycle. But then, really in the middle, again, you're relying on much of your current infrastructure, your current processes, your controls, as was said, really your current underwriting standards so you kind of see a little bit of a minimal impact kind of in the middle. And then again, at the barbell happening at the end, where I think based on some of the elements that Raj, Irina, and myself just spoke about regarding reporting, we do expect that really on the back end, when you're getting into more loan servicing, as well as, managing the portfolio and the types of information and reporting that you'll need to provide back into the facility itself and into the Fed, to be more heavy based on the lender's requirements. So this is kind of a view from the lender's perspective. And certainly this is kind of our initial view based on us absorbing the term sheet and the requirements, as well as some of the conversations that we've had. So I'll ask Roger or Irina and my colleagues if they want to add anything to this page.
Yeah, I would say that we fully expect that your existing loan capture, loan processing systems will be able to cope with this, with some changes or modifications at the front and back. One of the interesting things is that you yourselves would know that commercial loans take at least 4 to 6 weeks to process. Some of these added requirements might elongate the process. So one of the interesting unknowns is what happens if this process takes, how long will this process take from application to disbursement? And, one has to be aware that that is also something that might be a fact in the public domain, how long lenders are taking to disperse monies or funds. And so getting this process streamlined, but still foolproof is going to be important. The other thing that we would think that lenders like you would think about is not to have to make massive modifications to their existing systems. But if you had to do enhanced reporting, enhanced monitoring, and so on at the back end, perhaps looking for plug and play tools would be an interesting way to solve the problem versus having to go out and change your existing systems. But I think this gives you folks a good directional view of where to focus in order to be prepared once the facility or before the facility comes into operation. Monica?
Yeah, I think our recommendation would be is, just maybe evaluate certainly your current end-to-end practices and policy against, some of this that we've shared. I also think for those that have, there's a lot of lessons from the PPP process as well. While it's not the exact same, certainly in terms of the facility or the eligibility, there are some good lessons learned that I think you can apply here in terms of the types of controls and the enhanced reporting that we know lenders had to kind of take care of even with PPP. And so we're borrowing from some of those lessons as well as we think about Main Street. I don't know if there's any questions in the chat, but maybe we can continue and move to the next page.
Monica, we do have one question. The question is for the borrower certifications. The question is, as a practical matter, how much do you think that lenders can sort of solely rely on the borrower certifications versus how much would they be expected to, verify some of those certifications? And is that are there special concerns around that for FBOs, sort of either just supervisory expectations or maybe some of the reputational risks that might come with, certain borrowers?
Yes, so, maybe we first focus on the borrower certification question, and I can start and my colleagues can certainly add their thoughts. I know that certainly, as you read the FAQ and the term sheet, there's a heavy reliance, I think, that's being said that the lenders can place on the borrower certification. Maybe my personal view here is from a practical matter, again, given the risk here is very much so on the lender in terms of reliance on their controls and their practices. I do think lenders will want to have, be performing some level of review. Because ultimately they're responsible, right, for making sure that the borrower is eligible, and you've kind of done those checks and balances to make sure that before you actually provide the funding. And so I think it's a little naive personally to think that the lenders are going to rely solely on these certifications and not really do the right level of reviews and controls that they should be. And especially as we talked about, if these loans end up in any sort of default workout situation, I think the first question that will come back from certainly the Fed, as they review the facility and maybe even others, is, what reviews did you perform and how did you get comfortable before you actually made this loan? So that
I
would be
agree.
kind of my response to the first. Raj, you want to add anything?
No, I completely agree. I think the lenders, while they have the ability to just rely on the borrowers, I think the lenders should and will follow their own process, their own standards, and ensure that they can demonstrate consistency with existing policies and procedures. And I think that will be very important if there is any scrutiny at the back end. Not least because the lenders want to be sure that, that the Fed at some point doesn't say that this doesn't pass muster and that they would not participate in the syndication. So for those reasons, and of course the back end scrutiny, I think the lenders will be as vigilant as they normally are, or even more so.
Thank you.
Should we go to the reporting considerations? We think this is a significant, potentially, we should say, because clarity is yet to be given, potentially a significant requirement that will emerge as time goes on. Monica, right?
Yes. I think this will be one area that will continue to develop. And I think we do expect there to be more information and maybe even FAQs, et cetera, that will be raised as this area continues to be further designed and thought out. But if you look at kind of the principles that I know Irina even shared earlier in her remarks around the transparency that's really required for this facility in terms of disclosing, information about your borrower, the applications, the type of borrowers that you're looking at, as well as the fact that you're really the primary servicer in this regard and need to continue to service these loans and make sure that you're providing any sort of monitoring and reporting related to covenants, any tracking and exception type information back into the facility. We do expect that you're going to want to focus heavily on some of these reporting aspects, and also really think about how you're going to kind of segment being able to report specifically on the Main Street loans. Again, given that you want to have an ability to kind of, focus on that specific data and probably develop some specific reporting that you can share back into the facility. So this is one area that we do expect there to be some level of impact as you think about your process. And I know, Raj, you talked a little bit about looking at plug and play solutions to your existing infrastructure. Again, we don't expect you to wholesale have the time or even it making sense to change any of that infrastructure. But if you can add additional capabilities around reporting and analytics, I think they could certainly help in this regard.
I would agree, Monica, completely. And one of the things that I think about reporting, when I think about reporting, it's worth not making it a mass of reports. Maybe thinking about it as ex-ante reporting, and ex-post reporting. So when I say that, what I mean is once the loan is in the system, you may want to do some management type reporting for monitoring purposes to make sure that there is, that the criteria being applied are homogeneously applied or homogeneous. So you can kind of produce those kinds of ex-ante reports before the Fed or anyone else asks you for management purposes. And then you can produce reports, again, operational reports for monitoring purposes for these particular class of loans. And then at the back end, of course, all the kind of control reporting and so on that you need to do for public consumption. So I would try and break those up. And maybe in some cases, you will already have existing reporting capabilities that completely suffice for management purposes with some minor modifications. And then at the back end, you might need to think about some new things. So I would break it up into chunks so that you are, it doesn't become too much of too many reports coming out for different purposes.
And I think Irina wanted to add a few remarks, but she may need some help unmuting. Someone could unmute her.
There I am. So yeah, I think maybe a couple of things. I mean, I think to pick up on Raj and Monica's point, I know what's on the slide really talks about kind of what type of reporting may end up going to the Fed and Treasury and Congress is the point that I made. Probably the reminder here too is just because of the level of kind of scrutiny on these programs, the internal management, reporting, we would also view as key, right? So for those of you that have IHCs, you're going to have board reporting. You could have it at multiple levels as an FBO. You could have it at a US level, but then also your parent may be combining across the regions and in their home countries what type of government program support they're that your U.S. branch or agency or bank subsidiary is providing. So I think that, there's also that element is you've got, reporting into head office, you've got reporting into your local board, you've got reporting also across the three lines of defense. I mean, I think the bell curve, certainly that Monica talked about in terms of that value map is, or at the very, very beginning of the process. And so I think that one of the principles around reporting is going to be the agility of that reporting. Rather than creating a massive standardized set of reporting, looking at the attributes that are very appropriate for Main Street and being able to call that out, because the inquiries can also come many years from now. We all know if we look at the experiences with TARP as an example, you're going to have kind of the after effect and lingering effect of that reporting. So it's near term, it's medium term, and certainly long term. The other point I just wanted to make about kind of the borrower certification, and this may be an entry point into Steptoe's view from a legal standpoint. One of the questions that's come up certainly is around kind of the level of detail of the certification. We all know that, when an institution or a borrower is asked for certification, is there going to be some standardization, or is there a need for some standardization kind of across the industry? Is it a one-liner? Is it supported, by documentation? So I think that this is going to be one area to watch very closely within the FAQs, to the points that Monica and Raj made about kind of the risks associated with accepting it. So that one is, certainly on our radar screen in terms of watching if the Fed comes out with more specific FAQs. But certainly we view there's, some, legal risk and certainly personal risk in terms of whenever certifications are signed. So we thought that that would be maybe an element where our law firm colleagues may have a view as well.
Yeah, this is Matt Culkin. I'll start, and John or Josh, please supplement. Right, it's interesting that the Fed is publishing model documents, but they're going to require, or I guess allow, the lender to use their own materials, conduct their own assessment, apply their own underwriting standards, request additional information or documentation. Right, which is different than the SBA, where you take the certifications as promised and move on. In the PPP program, lenders are instructed to work with the borrower to remedy any false statements or any errors in the application. The Main Street program, through the FAQs, encourages the lender to go to the Boston Fed if you find any sort of misstatement or other breach of a covenant. So you can start to see the difference in the leniency for a lender to work with the borrower.
Which speaks to the grant versus the loan.
Mm-hmm. That's right. That's right. We're getting into bigger loans with more sophisticated borrowers.
That's right.
And the program is relying on the lender to have a more involved role in the vetting of the loan.
I would also add one point, which is interesting. We at Deloitte have some colleagues who are also helping borrowers understand the ins and outs of these facilities and how to avail themselves of these facilities. And so from that vantage point, we do see borrowers probably needing some help, to really understand what it means there are clauses like making reasonable effort to keep people employed. What does that really mean? What happens if you're a sponsor company, in a sponsor finance kind of scenario, and you don't have any employees, or you have very few employees, but you are actually borrowing the money on behalf of portfolio companies? What happens there? What is the requirement if I'm already distressed and my EBITDA is distressed, and what happens then? So the borrowers are going to need help and handholding, and I think that's still a gap where not clear how you fill that. Would you agree?
Oh, I agree. And the certifications on the lender that John just walked through and relate to the lender certifying, for example, that it conducted its EBITDA analysis consistent with prior practice.
That's
so
right.
They're shifting some of the liability, if you will, to the lender.
Yeah, this is John. I think when you look at those certifications for the borrower, I think, Raj, you just pointed out one of the major ones. That is that the borrower must make commercially reasonable efforts to retain employees during the term of the loan. And the FAQs have some explanation of that, where they talk about good faith efforts by the borrower to maintain payroll and retain employees. And then it goes on, in light of its capacities, that is the borrower's capacities, the economic environment, its available resources, and the business need for labor. So there is some further explanation of that, but you're right, it's still going to be a question in every circumstance. It's going to be very fact-based. I think the second piece, which has been mentioned by you folks, that the borrower certification, that it has a reasonable basis to believe that as of the date of the origination of the loan, it has the ability to meet its financial obligations for at least the next 90 days and doesn't expect to file for bankruptcy. Obviously, that if they cannot meet the obligations, it's pretty distressed, but it still points out, as you've described, the need for good underwriting by the lender. I mean, it really puts the onus on the lender. So despite these certifications, particularly on the ability of the borrower to meet its financial obligations, it's really an independent view of the lender that's important here on whether the lender should make the loan.
That's right.
Yeah.
We have a question about sort of fits in with this, and it goes to like supervisory expectations. So the program, and I guess, the interpretation of all these different issues that gals are raising, it's the programs with the Federal Reserve Bank of Boston.
We can't hear you.
Can you hear me now?
Yes.
Okay. So what I was asking is that the FAQ and the interpretation of all these requirements around the program done by the Federal Reserve Bank of Boston, but the examiners are coming out of the various Federal Reserve Bank where the lenders are. How will there be, and I guess this question isn't necessarily unique to this program, just interested in your thoughts of when there's something new like this and so many new programs coming out, how will there be consistency across these, the various Federal Reserve banks that are charged with setting up these programs versus the banks that the examiners will be coming out of? Any thoughts about that?
Well, this is
Well,
Irina. I might take a stab at that.
Yeah.
I think we do have to take into account that the Federal Reserve Bank of Boston is certainly running, kind of Main Street. Well, the other reserve banks, including New York, have responsibility for other facilities. So, one, we'd anticipate that the Federal Reserve Bank of Boston would certainly drive, kind of questions, any examination activity that the other reserve banks are employing. I think it's too early to tell exactly how they'll actually set up the supervisory structure. But if we look at kind of precedent in terms of how they do other, types of programs, they will probably pool resources from across the reserve banks where there are lenders involved. So that I think we could anticipate. But, as in any examination process, there'll probably be that combination of, if you're large enough to have a dedicated exam team, they certainly would be involved in asking many types of questions as Main Street kind of opens up and unfolds. So they'll be asking regular questions, of their institutions about participation. They're already asking all of you many questions about credit underwriting, trends that you're seeing, what the issues are with, workouts and troubled debt restructurings and the like. And then you're going to have this probably as a layer on top of it. But I mean, I would say a little bit too early to tell. But I think we have to assume that there is going to be some centralization through the Boston Fed, and then that getting filtered with probably examination staff getting pulled from across the reserve system. Matt, I don't know if you have anything else to add.
Well, Bridget, your question assumes there's consistency, and I'd say even just broader than the Reserve Bank
Right.
examiners, you're going to have the Inspector General for the CARES Act oversight looking at some of this. We've seen DOJ already start investigations for PPP loan fraud. Capitol Hill's going to impose its opinion on the program at some point. And so it's going to certainly be a broader circus than just routine examinations.
Yeah, very, very fair point. And I think, Monica, you mentioned early on and in the slides of the sort of, caught in the middle of, there's the reputational risk of not participating in these programs, and then the reputational risk that could be associated with participating in the programs. And it's going to be, very dicey about how you proceed. And I think, for FBOs, those reputational risks are even more, or have to be even more front of mind. So I think perfect. We're just at the top of the hour. I want to thank our colleagues and partners at Steptoe and Deloitte for this excellent program, put together quite quickly and comprehensively. We're going to have this available, the slide deck and the discussion, the webinar will be available to those of you who registered to participate. So follow up on that to let you know how to access it. But I want to thank everyone again, and hope everyone stays safe. Please reach out if you have questions that weren't answered today, and we'll try to get answers to you. With that, thanks everyone, and stay well.
Thank you.